Hey everyone, it's Julie here with TipRanks. Today we're taking a look at a few of the Magnificent 7 stocks that have been dipping in price lately. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today, we're taking a look at a few big tech names from the Magnificent 7 stock group who have been trading in the red so far year to date, but still come in with a strong buy consensus from Wall Street analysts. Now, these stocks have been on the decline due to overall market conditions, increased competition, and valuation concerns, but analysts still have a pretty bullish outlook for their future. So today, we're going to take a look at these companies, what's been going on with them lately, and of course, how Wall Street analysts weigh in. What is really exciting today is that we get to take a look at these stocks with TipRanks' newly launched AI Analyst Spark. This AI-generated report is data-driven and helps give unique insights to any of your favorite stocks. You can find Spark under AI Stock Analysis here on the menu on the left-hand side of any of your favorite stock pages. It gives you data-driven insights, breaking down strengths, risks, financials, and peer comparisons in an easy-to-understand format. Head on over to the TipRanks website to try the Spark AI Analyst for yourself and make sure to let us know your thoughts in the comments down below. Now let's dive right into these Magnificent 7 stocks. Looking at the group of Magnificent 7 under the Compare Stocks tool, I headed to Performance, and one of the things that stood out was that year to date, only Meta Platforms is in the green. And after being the best performer over the past year, Nvidia is now one of the worst performing of the bunch over the last few months. Under the ticker NVDA, they're currently priced at $117 per share, having climbed 32% in the past year. Looking at the last 3 months, however, the stock has fallen over 17%. Nvidia's stock did take a big hit after their Chinese competitor DeepSeek released their new AI model. The stock has also been facing some gross margin pressure. Taking a look at our AI analyst, the company's focus on meeting aggressive Blackwell demand has left it prioritizing manufacturing volumes at the expense of maximizing production efficiencies, which is weighing on their near-term gross margin results. When we take a look at their financial statement overview, overall they have a very positive score across the board for their income statement, balance sheet, and cash flow. Of course, the company has seen exponential growth across these over the last couple of years. If we jump down to earnings call summary, we can see that they had record-breaking quarterly revenue for their last earnings report back at the end of February, where revenue was up 12% sequentially and 78% year over year. They also saw their data center revenue more than double from the prior year, and their Blackwell sales did exceed expectations at $11 billion. Looking at the lowlights, though, they did see revenue decline in gaming and networking. They did see some China market constraints due to export controls and that gross margin pressure. It was down sequentially with expectations to remain in the low 70s during the Blackwell ramp. Overall, Nvidia does score a 75, which equates to an outperform rating. That score reflects its excellent financial performance and positive earnings call outlook, tempered by bearish technical indicators and a high valuation. When we look at the technical analysis, they do have negative price trends when it comes to that moving day average. But when we look at the peer comparison, they are on the higher end here. The sector average is 59, and they come in well ahead of that at 75, only being edged out here by Qualcomm. Now, there is no shortage of Wall Street analyst coverage on the Nvidia stock. One 5-star analyst from Bank of America weighed in following their latest quarterly report, calling Nvidia one of their top picks. They noted that the company reported 78% year-over-year sales growth despite headwinds that included DeepSeek, the Blackwell transition, and China restrictions. Q4 included nearly $11 billion of Blackwell sales, well above expectations, providing reassurance that the product is on track. They raised their estimates on stronger sales, partially offset by Blackwell ramp costs, and reiterated Nvidia as a top pick as it says the company remains in a dominant position of leading the AI market. The Nvidia stock has attracted 42 analyst ratings, which is definitely up there as far as one of the most rated stocks I've seen. And it does come in as a strong buy with 39 buys and 3 holds. Analysts' average price target comes in at $177, implying an upside potential of 50%. Looking at those ratings down below, 42 ratings is a lot to scroll through, so we're not going to do that. On the low end, in the most recent ratings, we do have 130 for an upside of 10%, some as high as nearly 74%, and pretty much all of the price targets in that double-digit range between 30 to 50% upside. Our second Magnificent Seven stock that's been dipping in price lately is Microsoft. They trade under the ticker MSFT, currently priced just above $400 per share. Their stock is barely in the green overall in the past year at 0.5%. In the last 3 months, they've fallen over 9%. Microsoft also felt the sting of the DeepSeek AI release, but has also seen some slowing Azure growth and has been investing a ton of money in AI development. Now, those long-term investments in AI, such as their $14 billion stake in OpenAI, are likely to pay off in the long haul, but in the short term, they have led to some concerns about short-term profitability. Their Azure growth fell to the low end of guidance due to go-to-market execution issues and capacity constraints. But despite that, the company recently achieved better than expected profitability with an operating margin of over 45%, and they do score an 81 on their overall here for an outperform. This tech behemoth has not seen as explosive growth as Nvidia has, but they do still come in with top scores when we look at their financial statement overview. With their income statement scoring a 95, balance sheet a 90, and cash flow 92. Their revenue has consistently grown with a 6.8% increase from the previous annual period. They have a solid financial position with a debt-to-equity ratio of 0.21, indicating low leverage, and they have a free cash flow growth rate of 5.3%. As I already mentioned in their latest quarterly report, that Azure growth did come in below expectations, but the company did have some other highlights. Their Microsoft cloud revenue surpassed $40 billion, growing 21% year over year, while their AI business annual revenue run rate hit $13 billion. That grew 175% year over year. The company also saw record commercial bookings, increasing 67%. Following their last quarterly report, we did hear from a 5-star analyst from Mizuho Securities. They reiterated a buy rating, but did slightly lower their price target. They noted that while Microsoft reported decent results, Azure's revenue growth was at the low end of the company guidance due to subpar non-AI go-to-market execution. Nonetheless, they remain confident about Microsoft, thinking that the company's revenue growth opportunities over the medium term and beyond are greater than many realize. They reiterated their buy rating, pointing out strong AI demand and monetization beyond Azure AI, and also noting Microsoft's resilient operating leverage and the company's expectation of operating margin expansion in fiscal 2025, despite persistent gross margin headwinds. Microsoft has 31 current analyst ratings and comes in as a strong buy with 28 buys and 3 holds. And the average price target comes in at $508 per share, implying an upside potential of 27% from current prices. Once again, we have a long list of analyst price targets down below, but you can see a lot ranging between the teens to 30% upside here. Our high-end price target of $600 would be an upside of 50%. On the lower end, we have a hold for an upside of 6%. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're taking a look at Amazon. Trading under the ticker AMZN, they're currently priced at $208, having climbed 20% overall in the past year, but you can see this recent decline. In the last 3 months, the stock has fallen over 8%. Of course, just like the others, Amazon is also facing some increased competition and navigating these market dynamics. On top of that, they've also had a big increase in capital expenditures when it comes to AI investments. And in their last quarter, they actually had some softer than expected guidance for their first quarter revenue. High valuation metrics may pose a risk, but the company's strong market position and growth prospects provide a solid foundation. Their AWS generative AI revenue is projected to grow significantly, up to $56.3 billion by 2030. However, like we said, their capital expenditures have increased greatly as they work on generative AI infrastructure, and this represents a significant cost that could impact the short-term financials. Of course, Amazon is another well-established tech giant with a solid balance sheet. scoring a 92 on the income statement, 88 on their balance sheet, and 85 on cash flow. Jumping down to their recent earnings call summary here, they did achieve record revenue and operating income. Looking at the peer comparison, they are right near the top of the pack here at 82. The only one slightly edging them out here at 83 is Alibaba, while their sector average comes in at 60. Amazon is another stock that has no shortage of analyst coverage, and we recently heard from a 5-star analyst at Loop Capital who increased their price target. They said that their firm is confident that their bullish thesis is playing out and still has meaningful upside ahead. And while its bullish outlook for AWS is a consensus opinion, the accelerated cloud migration and new use cases driven by generative AI is a massive multi-year growth cycle that should continue to drive shares higher. And with an impressive 47 analyst ratings, I think Amazon has the most analyst ratings of any stock that I've seen on TipRanks. And even more impressively, they almost come in with a unanimous strong buy. They could have 46 buy ratings and just one hold. And their average price target comes in at $269, implying an upside potential of 29%. Again, 47 ratings is far too many to go through all of them down here, but recently on the low end, we have a price target of 203, which would be a slight downside. Many of the others, though, ranging in that 20 to 30% upside, with high-end price targets north of 40% upside. So that is a quick look at 3 Magnificent 7 stocks that are in the red year to date, but do come in with a strong buy consensus from Wall Street analysts. Take a look at these stocks for yourself and let us know what you think about our new AI Analyst Spark. Always appreciate hearing from you guys. And of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always do your own research and due diligence. Thanks so much for watching. Have a wonderful day. I'll see you back here next time.